Recognize the systemic transition in financial services from digitisation to tokenisation. Another impediment that financial services and organizations must overcome is widespread acceptance of digital assets. Demand for exposure to digital and crypto assets has increased across all asset classes in the financial industry. This has resulted in institutional finance showing interest, demand, and investment in a variety of areas, including digital asset custody, digital asset trading desks, regulatory and compliance frameworks, and audit and risk models. Digital assets have undoubtedly taken the financial services industry by storm. While traditional finance's interest in and investment in decentralized finance, DeFi, is lauded as a progressive move, there are huge concerns and obstacles that financial services and institutions must face in order to mainstream digital asset usage. For one reason, the sector is undergoing a significant digitalization effort to replace antiquated financial systems that are ledger-based in nature. It must ensure that the path to digitization is easy and minimally disruptive, and that the financial system that moves assets and payments keeps pace with digital commerce and service delivery. These efforts have resulted in innovation in the form of application programming interfaces, APIs, that enable the development of new business models. Not only do these strategic APIs manifest as digital products and services, but also as vehicles for co-creation that add value to the consumer and financial services ecosystems. The industry has seen an increase in the use of whole lifecycle API management as a glue for securing organizations while also exposing services, which changes the IT focus away from projects and towards strategic APIs. Recently, the strategy has included financial technology, or fintech, alliances and/or technological modernization. It has concentrated on user experience and the API, paying less attention to the systemic parts of the financial services business, including payment, treasury, risk models, fraud, regulatory, and compliance, to mention a few. While the user experience method has had some success, flaws in older design components of closely connected architectures have become apparent. The use cases manifested as a financial application gradually outpace the restrictions of the financial systems, resulting in assets being stuck in the ledger and depending on batch operations to move them. Therefore, how can a financial institution handle these two diametrically opposed business models concurrently as the industry undergoes a complicated revolution with a disruptive twist? On the one hand, the digitalization effort emphasizes a ledger-based model, which is mostly dependent on existing infrastructure, while the disruptive twist advocates a token-based model, which undermines and negates the current digitization efforts. How do financial institutions maintain the delicate balance necessary for the coexistence of two worlds while providing a seamless, single experience? Recognize the impact of digitization and fintech-driven disruption. The financial services industry is constantly changing, as seen by recent seismic shifts. The business has through numerous past paradigm-shifting eras, including the introduction of computing into financial systems, anytime banking via ATMs, and the internet and mobile technology redefining the concept of anytime, anywhere. Today's financial services business is primarily focused on huge digitization projects, including open banking, Payment Services Directive 2, PSD2, Strong Customer Authentication, SCA, and ISO 20022 for payment harmonization and modernization. Many of these digitization projects are driven by industry, while others are prompted by a regulatory demand. They are initiatives to maintain competitiveness and to accommodate consumer requests for fast, real-time asset movement and digital fiat as a means of settlement. The financial services industry faces numerous challenges, including constant regulatory changes, customer expectations of digital natives, the requirement for real-time and round-the-clock operations to service clients' requests, and exogenous factors in ecosystems that create interesting technology engine struggles for financial institutions. The legacy infrastructure, which reflects tremendous investment and previous modernization efforts, is now limiting the pace and scale required to unlock the digital value of not only goods and services, but also the financial institution as a whole. Each time a substantial change occurs, the financial services industry has been able to adapt and weather the storm. Another significant transition is being driven by fintech, which is characterized by radically altered business models driven by new innovative technology, business structures, and the digitization of adjacent and consumer experiences across all segments of digital business and engagement. This transition, combined with increasing regulation, compliance requirements, and disruption from the fintech ecosystem, is compelling the conventional financial services industry to reconsider its innovation and business models. This is to ensure that systems remain competitive, innovative, and adaptable in the face of future disruptive transformations, such as DeFi enabled by tokenization. Recognize the consequences of asset tokenization. We have shown that the first stage in many corporate and permission-less blockchain projects is digitization. Tokenization is the process by which an asset or right is converted or claimed into a digital representation, or token, on a blockchain network. It may be prudent at this point to differentiate between a crypto asset or currency and a tokenized asset. A crypto asset or currency is a means of exchange or a protocol-driven exchange mechanism that frequently possesses the same qualities of a real-world currency, such as durability, limited supply, and network recognition, but is backed by a shared belief system, such as a fiat currency. A crypto asset or currency can also be thought of as a result of trust systems, or consensus, serving as a vehicle to back the incentive economic model that rewards and supports a network's trust system, thereby serving as the network's trust currency. On the other hand, a token can be a number of things: a digital representation of a physical good, so creating a digital twin, or a layer 2 protocol that rides on the crypto asset or currency and serves as a unit of value. This distinction between a crypto asset or currency and a tokenized asset is critical for comprehending the exchange vehicles, valuation models, and fungibility associated with emergent value networks that pose interoperability issues. The difficulties are not only technological, but also business-related in nature when it comes to equitable swaps. Asset tokenization can result in the development of a business model that enables fractional ownership or the capacity to own a single instance of a huge asset. The promised asset tokenization on blockchain-based business networks is not simply digitalization or a fix for time and trust inefficiencies, it also generates new business models and co-creations from network participants' synergies. While blockchain technology enables the network's trade, ownership, and trust. It is in the digitalization of value aspects that asset tokenization is critical. In essence, digitization is a necessary condition for tokenization. In the context of financial services, digitization of existing services and token-based DeFi are two distinct business streams that will converge as the sector strives to create a unified user experience. Tokenization suggests that account management and asset claims are governed by cryptographic keys, rather than by a system operator known as a bank. Though tokenization encompasses more than account management and asset claims, it enables divisibility, fungibility, and decentralized business operations such as asset transfer. It is a critical component and prerequisite for an Internet of Value. Observation. The answer to the question, how does a financial institution strike a delicate balance between coexisting in two worlds while providing a seamless and distinctive experience, is a difficult one. Appropriate consideration should be given to the operational structure, which must accommodate the complexity of existing systems while also accommodating the exponential development and complexity of a digital asset ecosystem. This poses a major operational problem as well as a vast potential landscape and channel for the development of new business models. It is widely accepted and understood that blockchain technology establishes the foundation for a trusted digital transactional network that, as a decentralized platform, fuels the growth of marketplaces and secondary markets through new synergies and co-creation enabled by new digital interactions and value exchange mechanisms. With a slew of open APIs, open banking has spearheaded the digitization movement. These APIs can be extended to tokenized asset structures, transforming the entire business process of various DeFi market structures into consumable units, with various asset classes, marketplaces, and DeFi support services stitched together to create a unified experience that hides transactional complexity. We hope you enjoyed watching and listening to this video. Please let us know your opinion in the comments area below. If you found our content useful, please like it and share it with your friends. Also, don't forget to subscribe to our channel and hit the notification bell for more crypto-related contents.